Pardon the jacket. It is, as I said, 20th of June in Melbourne, and it is absolutely freezing. There's only so much heating can do to keep things going. But thank you again for tuning in. As you would know or will have seen, my name is Jordan Vaka. I am an independent financial planner with the Advice Gallery. We provide advice to people across all areas of life, and currently we are wrapping up the insurance phase of our webinar series, our fortnightly webinar series. Keep an eye on the website for future webinar topics. We are moving into the investment phase next, which I suspect may be of more interest to more people, where we will start with the foundations and build from there. But I like to wrap up these little phases within the webinar series with a bit of a case study to try to bring what we've talked about into a more realistic context and one that resonates maybe a bit better. So with that being said, I'd like to introduce you to Eric and Ruby. The disclaimer is pretty important in this one because we will be talking specific amounts of coverage and specific premiums. I do not mention the insurer that we've quoted this on. We have quoted it with just the one insurer. And to be fair, we have used one of the more competitive insurers that are in the market, one that is much more modern in mind and approach. But in saying that, the premiums are fairly indicative of what is out there in the market. There tends to not be a huge amount of variance, but the bottom line is don't take anything that we're talking about in this webinar as advice. I don't know your circumstances. Be sure to obtain independent financial advice before making any decisions around this stuff. Usual refresher, life insurance, TPD, trauma and income protection, 4 main types of insurance. Life insurance is if you pass away. TPD is if you're made disabled, totally and permanently. Trauma is if you're diagnosed with a critical illness, and income protection is if you cannot work for medical reasons. Now, let's talk about Eric and Ruby. Let's sit down and have a chat about Eric and Ruby. Eric is 41 and he's married to Ruby, who's 39, and they're married and they have 2 kids. Eric is a consultant and he earns $140,000 a year, while Ruby is a senior IT manager and earns $180,000 a year. At the moment, they have their home, which is in the middle ring of their CBD, if you're in Melbourne, like an Oakley-ish area. It's worth about $1.4 million. They have a mortgage attached to that of $975. They have $15,000 in savings in the bank, $30,000 in assorted shares. For people that are listening or watching this that have more in savings, you would be surprised at how far outside the norm you are, in my experience. Eric has $165,000 in his super fund. Ruby has $197,000. For people that have watched other episodes, you will know that that is relevant because you will receive superannuation payments upon death, and so that can offset the insurance that you need. They've got some other bits and pieces floating around. They've got total car loans of $65,000 and a credit card with a $12,000 limit. It's often maxed out. They're not terribly organized around managing their money. They want to send their kids to the local private school. This is their big overriding aim. They have other financial objectives, clear the mortgage, retire early, those kind of things. But for what we're talking about today, this is the primary point, and that costs about $20,000 per child per year. Okay, let's talk a little bit about what they actually need to do. So with insurance, I've talked about this before, you can kind of insure yourself more or less for anything you want in terms of amount. But what it primarily breaks down to is in the event of death, disability, or critical illness, you want a provision made to eliminate or manage debt. You want something to take care of the lump sum expenses that can arise in that event, and you want to have a supplemental income coming in to replace what's been lost. They're kind of the 3 main primary tenets of insurance calculations. So, talking about what they need, Eric and Ruby were lucky enough to meet with a handsome, funny, and charming financial advisor. They decided that what they wanted to happen in the event of death, disability, illness, or ongoing inability to work was this. In the event that one of them were to pass away, they want the mortgage paid out completely. They want to clear all of their other debts. I'll step aside here and just say this is a point in time kind of thing. So we are trying to calculate the level of insurance they require now. Now, the traditional kind of trajectory is that they will pay down that debt over time, so their insurance needs may drop, or they may accumulate more debt. We cannot really allow for that, which is why insurance reviews are really important. Realistically, as a minimum, every 3 years, more regularly if there's been changes. So they want, upon death, they want to have the money to clear all their other debts. They want to provide for an ongoing income for the survivor of just $50,000 a year for 6 years. after taxes and bits and pieces and living expenses that are related to the now deceased working. They figure this will be a nice supplement, and it'll give the survivor the option of taking $50,000 a year for 6 years or $100,000 a year for 3 years, give or take. They want to allow for the 10 total years of private school education they have left. So there's a little bit of overlap where the kids will be at the school together, but then the elder one will graduate. So it's 10 years all up. They want both of the above to be adjusted for inflation. They've allowed the usual $10,000 for funeral and final expenses, and they want to use super and their other assets that aren't their home to offset that need that they have. So after calculating all of that, we apply some calculations around kind of the income requirement and the school fees and what that's going to look like. We determine that for Ruby, a gross need of $1.47 million. If she were to pass away, Eric needs to receive a check of $1.47 million to do all of this, which sounds right. I mean, their debt's $975. They're not looking for a huge amount of income upon passing away. It stacks up. Disability, similar process, slightly different answers. So they still want the mortgage paid out. They still want all debts cleared. They still want to provide for ongoing medical expenses. But instead of it being for 6 years, they want it to run through to the age of 65. So Eric's 41, that's 24 years. Ruby is 39, so that's 26 years. They still want to cover the private school costs and have both of the above adjusted for inflation, including that $50,000 one. Now, that third point there, providing for ongoing medical expenses, tends to be that when I calculate TPD for people, tends to be the reason that it's a lot higher than their life cover. Depending on their stage of life and all the usual variables, TPD tends to be a higher benefit amount because you are still around. You are still around and you are likely still to be costing money, to put it very crudely. So it does mean that TPD is often a larger amount of part of their insurance. Now, I should flag, and we go through an alternative after we've gone through all of this about how we can reduce their cover or their premiums. Every person kind of works out insurance a little bit differently. I think I flagged this in a former episode. Some people used to use a multiple of income, not very good anymore, but some people construct it like this. There's all different methodologies. So find one that works for you. The gross need in that case, this again was for Ruby, $1.995 million, effectively $2 million. Critical illness, this is different. So critical illness or trauma cover is a payment that you receive upon diagnosis of a critical illness. So it might be breast cancer, it might be a heart attack, it could be a stroke, it could be motor neuron disease. It could be anything that may be acute, may only last for 12 months and you'll be back on your feet, or it may be horrendous, become chronic, and then you'll qualify for TPD. Either way, you've got kind of a 2-year period where life's going to be really average. That's what this insurance is for. And because of that, and because of the frequency of claim, it is relatively expensive. So we try to keep the overall amount of cover required a little bit lower. So instead of paying out the full $975,000 mortgage, Eric and Ruby have decided to only pay the mortgage for 2 years, presuming that it's at a 10% interest rate. So essentially it's 20% of the mortgage balance now. They do want all the other debts paid out in full, though. They don't want to be paying car loans and credit cards in the event that one of them has cancer. They need to provide for upfront medical expenses of $100,000. So that's kind of, it's treatment costs. So you may have medication that's non-PBS. You may get hit with a bill outside of private and public healthcare. Or it may also be, we have heard of cases where people are allowed a little bit more, but there's a treatment out of UCLA in America. It's experimental. It's showing really good results for your particular illness. It's going to cost you $200,000 though. How are you going to do it? That's kind of where this figure comes from. And that $100,000 is a little bit how long is a piece of string. You could have it for $1 million. It's going to cost you a fortune. They still want to provide for the private school education, but they only want to do $20,000 a year. So allow for 1 year's worth of education and top up their income by 25% for the year of the claim. Expecting that they will be making a claim on their income protection policy in that event. So in that case, the gross need, and again, this is for Eric, I think, $460,000, which means that if they were to be diagnosed with a cancer and it met the severity terms and the trauma insurance paid out, they'd get a check of $460,000, put that in the bank and know what they're doing with it. They're not overinsured and they're not underinsured. And I think I've mentioned this in a previous one too. This prevents them having to do sausage sizzles down at the footy club to try to bridge the costs that comes with treatment. Income protection. So in the event of loss of income, they want to replace their income up to the maximum, which is currently maybe 70% now. They've made changes and it's really mixed things up. They believe they can fund themselves for 60 days before it starts between their annual leave and its sick leave payments they have through work, limited savings, and the other's ability to earn an income. They believe they've got a 60-day waiting period. They do want to pay them for as long as possible, though, and they wish to pay for it personally, not via super. For Eric, he needs a bit over $9,000 per month of cover on a 60-day waiting period to the age of 60. Ruby, $11,250, same waiting period, same benefit period. So, playing it all out, you can see here the numbers as they apply. I just realized there's not an error, but there's something I've missed. You go back to his TPD cover, $1.99 million. But you look here, the amount is 1.67. The reason for that is we subtract from that gross figure, that 1.995, we subtract from that his superannuation, their cash savings, and their shares to try to bring down the amount of cover, because the amount of cover will have a large influence on what the cost will be. So that's why these numbers are a little bit different for life and TPD. Trauma is the same. In large part for the trauma side, the variance there is because of his different income, because we're allowing for 25% of their income, but income protections as quoted. So you can see there, the trauma insurance is about nearly 45% higher in terms of an impact. Sorry, TPD insurance. And like I say, it's because you're still around, and it's not unusual in my experience to see a larger amount for TPD as a recommendation. But as I've said before, every person getting these quotes has the right and the ability to change them into something that would be more palatable, which is what we'll come to. Okay, let's talk about the cost, because that's what we're here for, to try to work out how much this insurance costs. And keep in mind that these two are 39 and 41. Ruby is a smoker, so that's one point of difference there, but they work in white-collar jobs with reasonable incomes, but a reasonably high amount of cover they're chasing. So, for Eric, full coverage. I've delineated these amounts by super and non-super. So the super amounts are being paid for via the super fund, non-super being paid personally because out of their personal cash flow. And you do that for a few reasons. Trauma, you have to do it. You can't hold that through super, so that's a no-brainer. Income protection is generally tax deductible. So to you personally. So while you can hold it within super, there's generally no real reason to, unless you can't afford the cash flow. So rolling all that up together, we can tell that for death insurance, he's going to pay $311, TPD $120, trauma $1184, income protection $912, for a total cost across the year, across super and non-super, of $2,500. Now I look at that and I feel like the TPD balance, that's a mistake. That is not correct. Maybe it is. Maybe it is. But one of the reasons I was trying to prepare this slideshow like this is to show that individual policies aren't super expensive. Death and TPD, particularly for younger people, are very affordable. And look at some of our other episodes where I talk about stepped premiums versus level premiums. These are all on stepped. Trauma and income protection starts to get expensive the older you get. Death and TPD, though, is dirt cheap. And that reflects the risk, right? I mean, the risk of a white-collar 41-year-old non-smoker becoming totally permanently disabled is pretty low compared to a 55-year-old smoking bricklayer, like we talked about last episode. In Ruby's case, it's higher. Even though she is younger, the premium is higher because of the smoking. So you'll see it's quite a bit higher. I mean, we're pretty close to, 80% higher. That's because death is more expensive. TPD trauma is incredibly more expensive when you're a smoker because your likelihood of claiming for a cancer, lung cancer, but also other cancers, is quite high. So the total cost across the year would be nearly $7,000 for a full comprehensive insurance package. Now, $1,200 of that will be coming out of their respective super funds, with the majority of the cost coming out of their personal cash flow. But keeping in mind that $2,400 of that will be tax deductible. At their current tax rates for Ruby, that's, I think, should be over it. Yeah, 47% tax deduction with Medicare. Whereas for him, it'll be slightly lower. It'll be 37% tax deduction. So still a significant expense, but for quite a comprehensive level of cover when you think about it. So one of the common measures we will use to try to determine affordability of insurance is we look at premium as a percentage of income, and we look at it as a percentage of balance of the fund. So when you're going through this exercise, I would encourage you to do that. You simply divide the premium by your income. I recommend doing it via net income, and that gives you a better idea of the actual impact. The common refrain from everybody that holds life insurance at the moment or in the last couple of years is, how can I make this cheaper? It's getting very expensive. I'm questioning the value of it. I know I need some. Do I need this much? Etc. Etc. So we've run an alternative set of quotes, but it is worth reminding or revisiting the fact that to reduce the amount insurance costs, you need to compromise. A compromise needs to happen somewhere, either on the level of cover, the quality of the cover, so the inclusion of other benefits and features, the breadth of cover, or on how you're paying for the cover, or a combination of all four. So after seeing the quote, Ruby, Eric, and their marvelous financial advisor discuss a few adjustments, and they decide that they'd like to reduce the life and TPD benefit down to an even $1 million. They've chosen to drop the extra TPD policy, acknowledging that it's a lower possibility for them, but also it's an extra expense, so they don't really want to carry it. They've chosen to reduce the trauma down to $300,000 instead of the $450, $460 they were looking at. They think they can possibly squeeze out the waiting period on their income protection by another 30 days, which will bring down the premium. And they are reducing the benefit on Ruby's by $1,250 and on Eric's by about the same, closer to $1,600 a month. So they are reducing the amount of cover. So if they were to claim on TPD, for instance, they will be underinsured by about $650,000 minus their superannuation balances. They've chosen to accept that risk in order to keep the premiums down. And how much of a difference does it make to the premiums? Well, not massive. It adds up a little bit. There are mistakes in that table. That table is not right. Apologies. But you can see here that it does bring the premium down a fair bit. Instead of paying $2,000 across his income protection and trauma, he pays $1,600. Death and TPD. TPD doesn't move around a huge amount, but the death's a bit cheaper. So across the board, he saves about $430 across the year. Why does TPD go up? Interesting point. I've mentioned in a previous one as well. Sometimes the higher the level of cover you get some discounts for having larger policies. So size discounts. And normally the thresholds are 1 million, 1.5 million. You get like 15, 20, 30% discounts on the amount above. By reducing it back down, you lose that discount and you go back into the higher percentage rate. Mistakes aren't in this one. So you can see here, the overall reduction for Ruby is much more significant, which isn't surprising because her insurance costs a lot more. So a dollar for dollar decrease leads to a bigger impact for her. So you can see there the overall reduction brings her down by about, let's quickly comparing. Yeah, that's all right. It brings it down by about $3,000. So combined, they save a little bit over. Yeah, they save a little bit over. This is also not right. I do apologize. I'm not happy with this number of errors in it. But they just save a fair bit. So it's costing them $5,900 on the reduced package, whereas before it was closer to $7,000. So by reducing that level of cover, they can see that it's going to save them a fair bit of money. But now the question is, do they want to? Is the saving good value for what they're trying to do with the other insurances? Is it worth the reduction? That's something for them and their advisor to work through. Once you've done all of that, your advisor will to and fro with a stack of different quotes and find your solution that fits in with your budget. Now, your budget may be zero, in which case there's no proceeding. But if you can help set a dollar budget after you've received the initial advice, it can make your advisor's job a lot easier. So once you've done that, You've decided which way you want to go ahead. You then go into the application process. And we have talked about this at length before, so I won't dwell on it. But essentially, you fill out an application form with a personal statement. The personal statement can be filled out or provided online via a telephone call or an online quiz. That's then lodged with the insurer. The underwriter in the insurer will assess your application, and they will assess the level of risk that's involved in your application for them to accept. If they believe that the risk is maybe unacceptable, they will exclude that particular risk. Or if they think that it's a higher risk, they will price it so you will pay more for that higher risk stuff. Exclusions and loanings we've talked about before as well. They'll then provide that to you. You will then make it. Pardon me. You will then make a decision. Excuse me. Pardon me. You'll then make a decision on how you want to proceed. Should you decide to proceed with the cover, it'll be brought what's called into force, and then you will be covered from that point on, so long as you maintain the payments. So that's a very quick overview. That process there that I've just described averages on 3 months, often touches 6 months. So just to be conscious of how long it can take. And that, everybody, is that. We've got our promotion going on still, in this promotional phase where we are not charging advice fees. If you wanted to arrange insurance advice or a review of what you've currently got, we can do that for no fee. Part of that will be us removing all the commissions on that policy. So you will be essentially getting a free kick in terms of a discount. Thank you. These are my details there. I'll leave them on the screen for a few minutes. And then I shall stop sharing. It was a bit of a lightning one. It was kind of just the challenge I had is prior to that, it went for about an hour and a half because limiting, as per my previous webinar, limiting the variables that you have to play with to bring down price is kind of a necessity when you're tackling it like that. Because if you don't, there's so many things you can change, you can get swept up in it and get really tangled. So the only lever we pulled in this case was to reduce the amount of cover they had. As you might remember from the last one, you can also, change the premium structure for long-term expenses. You can pay more of it through superannuation. You can, the big one that we looked at was Ruby not smoking anymore. And that would bring her premiums probably below Eric's all up, and that would make a big difference too. So there's always levers that you can pull. I just wanted to show one of them, and just to give you a realistic understanding of how much insurance will cost you now, particularly if you're in your late 30s, early 40s. I think it's a realistic description, subject to the risks that we've talked about in previous ones. I shall leave it there. Thank you again. Thank you for watching. If you do have any questions, be sure to reach out. jordan.vaka@theadvicegallery.com.au, and it'd be nice to have a chat. Thanks a lot. Bye.